Hey guys, this is Terry with Futures.io, and it's my pleasure to welcome back FuturesTrader71 for today's Ask Me Anything webinar. During the webinar, please feel free to type your questions into the questions box. We're going to do our best to answer them throughout the event. If you're watching us on YouTube, please do us a favor and give us a thumbs up if you enjoyed the webinar. And as always, please feel free to share, comment, and subscribe to our channel. It really helps us a lot. You can follow us on Facebook, YouTube, and Twitter with @FuturesIO. Without further delay, I'll hand it over to FT71. All right, FT, you should get the pop-up.
Okay, there we go.
All right, looks good. And let's see what kind of questions we got going.
Just before we get started, Terry, I just want to let everyone know that derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. And just remember that the information I'm sharing with you is based on my opinion and experience. Make sure you verify it before you use it in your live trading account.
Perfect. All right, let's see. Okay, first question is, being that you do not use time, what criteria do you use to measure and establish your opening swing high-low?
Okay, yeah, that question's a classic. I know it confuses a lot of people. The opening swing is just a way of identifying what are called MOO orders, or market on open orders. We're trying to see the larger time frames participation right at the open. So it has nothing to do with time. It has to do with, what is the first point where buyers stepped in and the low was put in, the first low of the day was put in very, very early on, and what is the point at which sellers stepped in, so the first high of the day is put in. And that could happen within 5 minutes. Sometimes on slow days it could take 15 minutes, and it could take a while. Let me share a chart here real quick and show you, for example, for today, the opening swing was 47.75. So this is a 2-tick Renko. Let's zoom in a little bit, and I'll show you that it's part art. It's not really a scientific thing, but it helps determine how the market's behaving. So here we see the market open strong this morning, immediately push up. It pushes to 47.75, and then we get the first set of sellers. That locks in the opening swing high. Okay, we see that it came all the way back around, and then we didn't get an opening swing low because it basically opened at 45, went to 44.75, and immediately started buying. We didn't really see where the market had moved before buyers step in. I mean, buyers just stepped in right at the the opening, and we don't get the opening swing low until 8:48 a.m. Chicago time, 9:48 Eastern, at 44.25. So the opening swing now becomes 47.75 to 44.25, and it's not, there's an opening range which you'll hear quoted, and it's from the back in the pit days. This is not the same thing as an opening range. There's a 1-minute opening range, 5-minute, 15-minute, has nothing to do with it. Yesterday, you could see that the market opened here at 36.75, pushed up to 37.50, and then it dropped to 35. So that establishes our opening swing for the day. And what I do with that opening swing is start to judge how the behavior is based on that first swing. If we swing high and then we swing low second and then end up taking the high, then I'm looking to trade from that direction. It shows that sellers were found, then buyers were found, and then the buyers were stronger or overwhelmed the sellers by extending the opening swing high up, and so I'll trade from that side until we fall back in and through. Then I'll start to change my mind. That's what it's used for.
Okay. Let's see. What makes a high or low weak?
Okay, so I'm trading the auction. So despite all these fancy lines and stuff that you see on here, I'm really just trading the auction. So this is much like you bartering on the price of a car at CarMax, or negotiating the price of an artifact at an antique market on a weekend. There is no established price. You're determining value based on how much you want that particular piece of antique, and the seller is establishing how much they're willing to sell it for or let go of it for. And so the market's constantly looking for what value is and what the extremes are. So it's seeking balance. The market really wants to sit sideways. That's its main course of action, and that's its purpose. When it's going sideways, that's the time where the most buyers and sellers will come in. That's what forms the point of control, right? So to answer this question, if the market moves up, let me get my drawing pen here, my fancy pen. If the market moves up, let's say it moved from here to here like it did this morning, right? So it puts in this high, and then it pulls back, and you can see that it moved all the way down minus a tick. But let's say it moves back to the high, and it retests that high, and then starts to move away from it. What the point being, if this high is unfair, meaning this high showed an extreme price that is unfair to the buyers, then the market would move away very quickly. The market would move away very quickly from that price, and it wouldn't just linger there. But because it rechecks it, it leaves behind something that looks like a double top. Oftentimes what we see in the profile is it comes up and then suddenly goes blunt. There's a lot of trading that occurs at the high, and then it just doesn't fall off. The best high or low is where the market moves there and then immediately finds the opposing force, in this case sellers, and then immediately finds the opposing force, which is the buyers. Those are good highs or stable highs or excess highs. And what we have here, like this afternoon's low, not the best low. The market tested it several times. You can see there isn't a very sharp taper here. There's just kind of a blunt step versus yesterday's low, where as the market trades lower and lower and lower, there's less and less participation. What these bars are showing is how many contracts to the tick, how many contracts traded in this area. And you can see that as price moved down, it went from 25,000 to 15 to 15 to 16, 18, 22, then 16, 10, 8, 3, 1, 3, 2, 4,000, and it tapers down to 2,500, and it trades 50 at the low. So as price went down, the auction just became uninteresting. The participants weren't there anymore, so it tapers off. Whereas today, it's pretty blunt, right? It goes from 32,000 and it moves to 24, 23, and it stays at about 14,000, drops to 8 to 6 to 372 contracts traded at the low. This is not a very stable low, in my opinion. This low is likely to be taken out overnight. It's not the greatest week low, but if it was a strong low, you would see the market move there and immediately bounce up. And so the profile would look very slim down there. It would look like this, where the sellers were shut off, the buyers stepped in, and then the market price immediately confirms that by moving in that direction. So that's the difference.
Okay. When creating your hypos before the market opens, do you give any priority to specific types of levels in particular? Example, VPOC, LVN, when low and high, etc., etc.
Yeah. So my approach to trading, if you've ever seen the YouTube live stream that I do every day, you will have seen me go through the news and go through what's expected for the day, and so on, and then I would, check. I check the bigger picture, then narrow it down and look at the overnight, look at what we did yesterday, the story of yesterday, and then look at the overnight session, the current overnight session, and then based on what I saw in the bigger picture plus the overnight, I form what are called hypotheses, or hypos for short. And so my approach is to always come in with at least 5 hypos. Every day gives us 5 hypos almost automatically. The question is, in the current context, which is the most likely hypo to play out? That's hypo 1. What's the second most likely? That's hypo 2, and so on and so forth. And in formulating those hypos, I'm looking at a lot of things. I'm looking at how the auction's proceeding, so you could see that today we continued in this balance. So it seems like we're really moving around, but we really haven't done much. We've been stuck in the same range that we put in on the 11th, on the Tuesday from last week, where the market dropped and then it came back up. And we've been trading basically in that same range, Tuesday, Thursday, and essentially sitting sideways. So that's the most important thing I take into account. What is the current market condition? I have a sticker on my monitor here that says, which way is risk moving? Is it moving on or off? And when the market's sideways, it is doing neither. It is just market stabilizing, it is trading, and it's essentially waiting for the next piece of data to value the price of the S&P, and then it starts to move. And this stuff happens in crude oil, in stocks, in whatever. Anything that has a price and enough volume follows an auction, whether you trade fibs or CCIs or whatever. It doesn't matter. It still follows an auction. That's what moves price, is the auction. And so the auction pieces are the most important pieces. How are we moving relative to yesterday's value, yesterday's point of control? What have we done? Like today, I expected it to bounce on the open, drop into 41 and quarter, 40, and then I expected it to find a base and continue higher. And the reason I expected that is because we've spent the last 3 days here just balancing below, and we finally gap up. So we've been balancing for 3 days, and we finally gap up. I expected the last 3 days worth of balance to behave as support to push us to the next area, which is 53 and a quarter up here. 53 and a quarter is the next key level up right here. That is the point of control of the last balance zone before before April 10th. So that's an important part. But then I also look at, it's hard to answer this question because the importance of levels or zones changes depending on what the market is doing at the moment. So here's how to look at it. That's not intended to be a fluffy, non-committal answer. It is fact that the thing that I'm looking at is really to answer the question, what has it done? What has the market done so far? That's what the Trader Byte's built on. That's what the hypos are built on. What has the market done? What is it trying to do? So the effort that went into pushing, gapping up in the overnight has been superseded by selling into the day session. Crude oil got pummeled today. And so the market followed the fact that crude oil fell today, and it just could not hold, even though this was really a high probability play to the long side coming into today. It really was. Under normal circumstances, I would expect to be trading long all day today, which wouldn't have worked today. And so what is it, what is it trying to, what has it done, what is it trying to do, and how good of a job? If it's trying to go higher and it just keeps getting pounded and pounded and pounded, meaning every time it goes up, there are sellers that come in and hit the market, then it's not doing a very good job. And then so that leads to the fourth question, which is what is most likely to happen next? And that's the question that leads to our trade, to our very next trade. So but I'm looking at things like naked points of control, naked closes, gap zones are very important. I have them noted here, gap zones, the prior weekly high, the prior weekly low. We've been trading inside of last week, all week this week. Those are key areas, and I put them in here on the chart, and I monitor how the market behaves. It's almost like monitoring a patient. and seeing how they respond to various drugs. You know, you're creating a hypothesis, you're administrating the antibiotic, and then you're monitoring how it behaves, and then that dictates what you do next. It's a very holistic way of trading as opposed to just trading based on math, which there's nothing wrong with that. It just isn't the way I trade.
Okay. You kind of touched on this in the last question, but the question is about the correlation between oil and ES, and how do you adjust your decision-making process for days like today when inventories come out, and how much weight do you give oil on Wednesdays rather than the other days of the week?
So I used to, when I moved to trading futures back in 2002, our entire edge was built on having a screen that basically showed 8 depths of markets, and then we traded across markets all the time. So you're trading the relationship between products, and after watching products for hundreds of hours, you start to see a correlation. The problem with that is we were doing it at a very short, in a very, very short time frame, so we were not subject to the kind of bigger waves or bigger time frame motions of the market. And so we could afford to do that. Now you can't trade, you can scalp, you know, in the, 5 second to 1 minute time frame still. It's very expensive to do that, and you're competing with very high speed machines out there. But as you move your time frame higher, those correlations get very tricky, in my opinion. One day you may see crude leading. Another day you may see that we're fading crude, we're trading against crude. Sometimes the euro will actually move the ES, believe it or not. Other times it's not correlated at all. And so it's really hard to put a finger on, if you're thinking, if the basis of that question is, when can I trade with crude, or can I use the ES to trade crude, or can I use crude to trade the ES? I would say that is a very, very tough way to trade because the correlation changes all the time. Now, there are components of the ES that are based in energy, right? There's a fairly significant part of the S&P 500 that is energy based, and as the crude gets pummeled, those stocks are likely to get pummeled as well, and so that starts to drive the movement in the ES. However, the weighting of those energy stocks in the ES changes and has diminished a lot recently because of Apple and Google and the technology sector, as well as the financial sector. So it's a changing behavior. The question you have to ask is really, why is crude dropping as much as it did today? Was it really the inventories number? Because the inventories number was not far off, yet crude is off, over 3.5% today. It lost almost $2. And so whatever caused crude to drop that much may weigh into how certain stocks do in the S&P that might have a pretty decent weighting. It's a very tricky question. I'm not enough of an analyst and an economist to be able to answer it. My point is, I just don't put a lot of faith in trading one product based on the movement of another. I've seen people get absolutely crushed doing that, and I've been crushed in certain circumstances as well trying to do that.
Okay. In terms of the trade direction, do you have a specific approach to choosing from conflicting probabilities if they're roughly the same?
Okay, that's a good question. So here's the thing, and I think I've covered it in the last AMA, and obviously not everybody was there, but the first thing you have to define as a trader, really, I think, in my experience, to be successful, is you need to define your time frame. It's really paramount to understand what your time frame of trading is versus someone else's, and versus the probability that you're trading against, right? And so if you're looking at a statistic that says, for example, there is a high probability in a certain situation that we will likely touch yesterday's closing price given certain conditions, like we gap up like we did today, and then yeah, let's take the classic rule in market profile. I don't want to call it a rule, it's kind of like a hypothesis that if you move into value if you move into value from any direction and you stay there for 2 periods, which is 2 30-minute slots, then there's an 80% probability that you would test the other side of value. So what that means is, as we move in and value high of yesterday was 23.42 and we sit here inside of value for 2 TPOs or 2 half-hour periods, touch inside of that, then there's something like an 80% probability. And by the way, I've tested that number. It doesn't come out to 80%. It's an old statistic that people keep using till this day. But there's a high probability, and it did work today, that it would test the other side, which is 36.50. Okay, but if you're using that statistic and you're a scalper, then it's going to be very hard to make money consistently doing that. But if you're someone who's holding for a swing, then that's more of a swing stat, because you have to sit there and wait for the market to actually, for the day to finish, because that statistic is based on the whole day. Like for any given day, if we touch this side and we stay here for this long, then we'll touch the other side. So the time frame of that statistic is the entire session. But if you're sitting here trading for that particular statistic, yet you only hold for about 2 minutes, then you're going to find that your results are not going to reflect over a large sample. They're not going to reflect the statistic you're trying to trade. So when it comes to the probability of which probability do I go for when things are conflicting, the question I always ask is, and this happens almost automatically without thought, which one applies to me right now in my time frame? So I could make an argument for getting short on a longer trade today, a 1 hour to 2 hour trade, but I can convince you that you should be getting long in certain areas, but those trades are only 5-6 minutes long, so any new low that then forms a zipper and starts to break to the upside, take that long, look for 6 ticks, do that all day long, for example. And so it's again, it's a time frame based thing. So when you're comparing probabilities, make sure you understand what is the basis of that probability. I hear people citing weekly statistics when they're trading on a day trading basis. I find that it colors your bias and it colors your decisions in a very disadvantageous way. It could really hurt the way it could hurt your ability to see the market for what it is. I hope that makes sense.
Perfect, thank you. During the session, if your hypos either play out or become obsolete, do you create more midday or do you stand aside?
Yeah, well, I look for, so my plan for the day, the key trades of the day are really to get me started on the day. I could say this very confidently that you're going to make your money, if you're going to make money in general, in most cases, on most days, you're going to make that money earlier in the day. Most people. Some people don't. Some people lose money for the first hour and a half. So they stay out of the market. If they're using something like the trade analyzer and look at their statistics, they might say, man, I lose money in the first hour every day, so I'm not going to trade. And they end up trading the time period of the day where I would never touch the market, let's say, where it's like lunchtime and there's nothing going on. But, for me, I generally need to come in with a real clear set of plans, and then my job is simply to monitor the market. I mean, if I'm looking for points to buy, for example, Hypo 1 today was a test of the prior day's range, potentially pushed to 41.40, and then bounce up and push to 53. So I'm looking at this push down to 44.25 very closely, and I'm monitoring how is the market behaving underneath it. Let me turn this off so this doesn't get messed up. There we go. So I'm looking, early on to see what kind of support in the order flow am I getting on the first test down. So here's the market. It opened, it tested lower, and as I zoom in here, there isn't much to support my trade. The wider, the bigger the bid, and there's a lot offered up there. So I tend to stay away. But let's say we play out, like yesterday, we played out Hypo 1 very quickly. Yesterday's Hypo 1 was a head and shoulders formation, open auction, push up, pull, push higher, pull back, a failed attempt at the high, and then a drop. That's what I drew in the pre-market video. And basically, that played out here. Once we broke the overnight low, actually it was somewhere here. Once we broke the overnight low, Hypo 1 was complete. Now, does that end my day at about 11 Central, 12 Eastern? No. What then happens is I start to look at what have we done so far, and then just do the same thing without as much detail, because now I have all of this wonderful new market generated information. And now I'm looking at, okay, how is this low being made? What is in this area? So the prior day's low was down here at 28.75. There's still an opportunity to continue this move lower. As soon as the market starts to break into the IB, then I'm starting to look at this noise, and I'm relying on the balance or the zippers that were created before to judge how the rest of the day is likely to move. And then I look for trades. In this case, there were just scalps. Look for trades in this closing range. A lot of times we will end up just doing this exact thing, but sometimes the market might push so far down and into key areas that it might end up rallying 15 points on the close, and those hypos that I made in the morning are no longer relevant. By the way, I just want to make sure I point out, for those of you who are wondering what the heck I'm talking about, hypos and all that stuff, just go to youtube.com/FuturesTrader71 and subscribe to this channel. And what will happen is tomorrow morning, and I do this every morning at about 9 Eastern, I do this live stream where I go through this stuff in real time before the market opens, and I review what I said yesterday versus what the market did. And you'll get a better feel for what I'm talking about. I'm trying to describe too many things that are too detailed for the context that we're in now, which is just an AMA answering individual questions. It's hard to get into a lot of detail here.
Let's see. Oh, I gotta find the question again. I recently binge listened to audiobooks of your recommended reading and loved the book on habits. What habits have you eliminated and or adopted that have made the biggest difference in your trading?
Okay, so I've been trading a while. If I was to, I would say the most relevant answer to your question is to go back to the times when I was struggling and looking to make the turn. And one of the things that really helped me regain perspective on what I was doing is the built-in idea that the harder I work, the more I look at stuff, the longer hours I stay up to look at the markets, the better off I will be. And so there was this habit of just coming in. You know, I was trading for a prop shop here in Chicago at the time. I would basically go into the office and get crushed within the first hour or two and be limit down or close to it, and then I would spend the rest of the day just kind of mulling over what I did and recognizing how stupid the trades were and what I should have seen and so on. And the habit was to just draw that out and just think that the harder I work, the better things will be. And it's not true for trading. What you have to do for trading is to focus on a very limited set of things. Like, focus on what it is you want to trade. So maybe you saw a journal on Futures.io by someone who's using fibs, let's say, and you think, hey, this really makes sense to me. Fibonacci is the stuff that makes sense to me. What you'll want to do is focus on that and build your routine and study and research around that, and just get into the habit of looking at that particular thing, doing a little bit of research, and focusing on what it is you're doing that is causing errors or the things that you're doing wrong. So I see a lot of people talking about a lot of stuff, but when it comes to execution, it's like a whole different person there. The habits that really help me as a trader holistically, rather than the technical habits, which is what I was addressing, are meditation. A very huge part of who I am and my performance as a human being, as a father, as a whatever, are built around the ability to focus for a long period of time and to be stable and with my self-awareness regardless of the circumstances. So one of the things that comes into trading all the time that's not talked about as far as I can tell, that is key to my performance, is my ability to be aware of where I stand, mentally where I stand, to be aware of when I'm tired, or to be aware of when I need a break, or to be aware when I'm being too aggressive for the circumstances at hand, things like that. And the thing that made me very, very sensitive to this is meditation, because meditation does that. It, does this thing to pretty much everybody I know who's started to meditate, and that is to just declutter your mind. It gets rid of that squeaky noise you hear when you're in a dark room with your eyes closed. There's this noise that's in your head. It gets rid of that. That's stress. It's energy that's bouncing around your head. As soon as you can get into the habit of calming down those stresses and calming down those thoughts, the noise that's constantly going on, you'll start to see that things become more focused. You don't need to fight a sell-off all day long. You're aware of the sell-off. You're there. You're present. That's a key habit for me. The other habit that really helped me change how I see things is to just consistently, as bad as things get, to just fine, you want to complain, whine a little bit, but move past it and be thankful for what you have and who you are. It's a very important part of life in general, and it dictates how I see things. Like, I'll complain to people about certain things, but you have to get into the habit of just moving past that real quick. If you play victim in trading, you're essentially turning yourself into a gambler slowly, because as a victim, sooner or later, you'll start to retaliate, and you'll be retaliating against the market because you're not getting what you want. You're not getting the results that you want. And so get in the habit of just reminding yourself that you're not, in Aleppo, Syria. You're not getting the mother of all bombs dropped on you in Afghanistan. You're fed, you have a home, you have an account, and you're trading, and life is good. And that's, that has nothing to do with like some sort of a technique for trading. But I'm going to tell you that once you get those sorts of things straight in your head, everything else, at least for me, just falls into place. I start to know what to focus on. I start to know what to ignore. And trading is just a great way to learn about yourself, because the markets will test every part of your personality and your mental grit all the time. And those people who make money in trading, unless you want to be one of the 1% elite traders, you can grind out a living in trading, in my opinion, following some basic practices. That is, every day has to focus on some issue. Like if you're Serena Williams out there and you're practicing, you're spending precious time on the court practicing, you better be working on that weak, whatever, backhand or some issue. You're there just to focus on that one thing, and you're just going to beat it out of yourself. You're going to build a technique or a habit that will eliminate that error when you're in the heat of battle, because at that point you can't sit there and go, well, should I move my stop? It should be set in stone. It should be there. You're just executing it. And so come in, it's really important to get into the habit of coming in and knowing this is what I'm working on. This is what I screwed up yesterday. This is a weak point. This is what I'm working on today, and keeping track of how that performance, how you're performing in relation to that particular thing. Anyway, I could go on and on about the subject, but those are some things that are near and dear to me. The habit of focusing, being able to focus your mind for a long period of time, being very self-aware, having gratitude, and coming in and focusing on a very deliberate thing you're doing for trading. It's a high-performance endeavor. It's not for everybody. You're here, you're competing with the biggest and the best, and you don't have to be the biggest and the best to make money. You can be in the middle, but it requires you to have enough skill and grit to stick around, manage risk, and build the habits that you need in order to make money given the market cycle or the market environment that you're in.
Okay, let's see. Where did the question go? Okay, do you ever consider standard deviation when using volume profile in the direction of the market?
Standard deviation in using market profile in the direction of the market, I'm not sure what that looks like. Value is a measure of standard deviation, but I don't know what that looks like, and I've not explored that at all.
Okay. Let's see. Do you use Investor RT for analysis, and why? And what do you use for trading?
I use Investor RT for pretty much everything other than execution. So the software itself is very, very powerful. You can do a lot. I can build spreads with this. I can do research on as much data as I want. There's a lot to do that you can do with Investor RT. It's a leader, in my opinion. It's a leader in this space, especially in the futures space. I see other platforms that just jump on and copy whatever Investor RT puts out there, and that's a good sign. But Investor RT for me does everything from giving me the ability to do simple studies like exporting bar charts with certain studies that it's already computed in here, to drawing the most accurate profiles that I can get my hands on, given that your data is good enough. It's able to connect with just a huge number of platforms. It can connect with everything from IQ Feed to the S5 Trader to CQG is coming here in the next couple months where it will connect directly to that. eSignal, interactive brokers, whatever. It's worth to me, if you're going to go and you're going to do something professionally, you should have the tools that give you the highest level of confidence. So the worst thing that can happen during the day is my charting platform has unreliable data because it's got some bug or it's got some weird glitch, and I lose data or something. That just, to me, that is too costly, and I lose confidence. I don't want to do anything or use anything that causes me to lose confidence in the information I'm basing my trades on. So IRT has been very, very steady very stable. They update. Heck, I get IRT updates probably once a week, I would say. So they're on top of it. I have the lead engineer on my Skype. If there's an issue, I have a good relationship with them. They're very responsive. To me, it's worth whatever it is. I don't even know what it costs anymore. Maybe 80 bucks or 90 bucks a month. And the other thing is, these levels, these flex levels here, you know, I can distribute these to anybody who has IRT. They can grab them from my server. They just point their you know, their chart to them. These chart definitions, anybody can grab these chart definitions and have the exact same charts as I do. So for people who are in the S5 chat room or who are following along or trying to learn, I don't have to send instructions on how to put up a line or do something. I can just send them the chart definition, they load it, and it's done. And for me, for the cost, it's definitely worth it. It has a steep learning curve. It's not, you know, it's not a super user-friendly when you first use it, but the power, once you figure your way around it, is really unmatched, in my opinion. I've been through CQG. I've been through, I used CQG for a long time in my prop shop, the integrated client, at what, $900 a month. I've used TradeStation. I used something else. Maybe Market Delta charts or something, and I ended up going to IRT back in 2008, I think, or 9, and I have not moved since. It's just a powerful package. As far as what I use to execute, I'm trading through the S5 Trader from Stage 5, who's a sponsor at Futures.io, but I've stopped loading the trading platform, and I'm just using this. I just trade right off of the right off of Bookmap. And why do I do that? I've always used order flow in my trading. So I think that whether you're scalping, so people think order flow is for like short-term scalpers. It's not. Order flow is for any time you're engaging with the market. And for some people, they don't care what's happening within a 4-point range. They just want to get in, and they just get in. Those are swing traders and so on. For me, it's really important to engage with the market and get as close to my exit as possible. And so it's really important for me to see where the market depth comes from. You can see, like here, the market, this afternoon, the S&P dropped to that 3350, and right after it dropped, you could see a bid stepped in here. It went from having 692 contracts bid to 1,100, and it started to solidify. So you can see down in this area, or actually I could do this. Look at that bid. It went from 600 plus to 1,100 to 1,300. Look at how it starts to increase, 1,300, and it continues to increase, and it gets even bigger later in the session. That's important for me to see, not because I can trade against that, because the market has already moved away, but it helps me see, does that bid stay there when the market starts to move down? You can see that as the market moved down, that bid canceled and it went gray again, which means it went smaller. It helps me see what the intent is of the market depth. If you trade with the market depth on a regular DOM, it's not telling you anything but what's there at the moment. With this, and these Bookmap are the pioneers of the order flow and market depth heat map, and they've been very responsive to what I want. They've developed a lot of stuff for it based on what my requirements are. Now I don't have to remember that there was a big offer here. I can see that on the on the beige book we dropped, and then we collided with all this volume here, all these bids held, and they actually traded through them. You can see there's big collisions that occurred right here at 115, and the market stabilized. I don't need to remember where those are. I don't need to remember that 38 to 37 had big bids that traded through. I can just see that by zooming out. I can see where that was, and so I execute through it. So when I turn this on here, hang on, when I turn this on, I can go and I can enable my trading capability here and set my size, and I can place orders everywhere just like you would with a dome, but you get to see what's going on. And on top of that, we coded this special indicator on here called the theoretical average, which helps me control risk. This used to be just a number, and it shows up as a number in our trade analyzer. But now I can see where my risk is on any given position using this yellow line all the time. So the tools are becoming, the tools that I'm using are becoming more and more sophisticated as the market becomes more and more sophisticated. And these are very, in my opinion, for whatever, $100 a month for IRT and 50 or whatever it is dollars a month for Bookmap, it's relatively cheap versus what I used to use in my prop shop, which is a $1,700 a month X-Trader Pro and a $900 a month CQG. And the data, the quality of the data is the same, if not better. I hope that answers that question in full.
Okay. You had mentioned zippers. Can you elaborate on what a zipper is and how to trade it?
Yes. Okay, so a zipper, for lack of a better name, I just didn't know what to call it. A zipper is a consolidation area. So the market moves look something like this. The market is stable, it's balanced, okay, and it's trading back and forth, and we're all bored to death. Eventually what happens is there's so much volume, and if this was a volume profile, there's so much volume that's trading here that eventually one side or the other is likely to be wrong. And what happens is it breaks. It goes into imbalance, okay? And then once it breaks, it tends to overshoot the next area of balance. It tends to find its buyers. So as it's dropping, it's finding buyers, and then it bounces up, and then it starts to balance again. So now we're back in balance. We went from balance, imbalance to balance, and we start to consolidate. And in general, if this is a large move, I call this an impulsive move. In general, it takes another leg for that move to actually get to its equilibrium point. Then it balances again, and then it starts to correct, right? So this is a typical, like a complete move on the sell side. So you have balance, imbalance, balancing, completion. This is the impulse move. This is a continuation or extension move. Then you have balance again as we are done. We found our buyers, we are done. And then you have a small move up, consolidation, and then the corrective move going the other way as the market reprices itself higher. It found its buyers down here, and now the sellers are backing off. These small balance areas, I call zippers. These are all zippers. If you look at your jeans, and you look at how the zippers formed, it looks a heck of a lot like these things, right? It looks like these little bars here on Renko. That's why I call them zippers. And these zippers, even though they seem very benign, they're very important in determining how the market responds to certain areas. So I talk about this all the time to our members at Stage 5. So it's kind of a worn out subject. But in general, I am using not the move. So this is obvious. This big move here is obvious. Let me clean up the screen here a little bit. Erase all. So this move here is what everybody notices. Wow, look at that move. It's a 7-point drop, just like that. That's what shows up on everybody's charts. It shows up as a big candle, and people start to measure. It's really the zippers that are telling you what happened inside of this. Wow, that's a terrible arrow. What happened, what's to be expected, what is likely to happen based on the move that just happened. It's the zipper that is likely to determine where the market goes next. So if a move does this and there are no zippers, this generally is a news-based move. High time frame is the higher time frame is in control, also called the OTF, the other time frame, and you need to stand out of the way. A market that drops, then zippers up, this is a market that's giving me the opportunity to jump in the direction of the drop. And in general, when the market pulls back, it's pulling back to this zipper. This zipper here ends up being a zone in which There is resistance if you're approaching it from below, or support when we're approaching it from above. Even if it's for a short period of time, it tends to provide a zone, again, not a level, but a zone of support or resistance. So if I missed, in general, I missed these big moves. If I miss this big move, in general, I will wait for it to pull back like it did here, to wait for the next move, and there it goes. And then, as you see here, and you see this all day, every day, and then we form another zipper right there, and you see when the market breaks and it pulls back right to that zipper. Just like this 41 pulls back right to that zipper, okay? And it continues. Once we break through to the other side of a zipper, let's say we move lower, and then the market starts to consolidate, and it forms a zipper at the prior zipper. And if I'm short, I'm out. It should not be forming the zipper. It's most likely going to resolve the other way. In general, it's the people who are long and are still holding long as this drop tend to create that resistance as we come back. But if they continue to trade, if there's a lot of trading going on as we approach a zipper, it's not likely to hold. So this is I could write a whole book on zippers and how they respond, but essentially the zippers exist on a 1-second chart, on a 1-tick chart, on a 15-minute chart, on a 60-minute, on a daily, on a weekly. It's the same idea. Balance leads to imbalance, leads to balance, leads to imbalance, and then correction, balance, continuation. And I'm using these zippers to control risk, and I'm using them as well for entries on pullbacks if I can't catch the move. It's just a great way to gauge, in my opinion, a real-time way, more than any moving average or anything else. It's there, it's in front of you, a real-time way to gauge how the market behavior is treating the prior levels. And that's a lot of times people don't want to, they want to win all the time, but a lot of times I will sell short against a zipper and it'll push through and I'll lose. So it comes out the other side of the zipper and boom, I just took a stop. But that's really important information, that the market that's been trending down has pushed through a significant zipper here. It's been sitting here a while. It's got a lot of volume. I can see the profile of it, and it's pushing through to the other side. It's telling me that this low is likely to hold and start looking for pullbacks into other zippers to get long if there's a hypothesis for it. If there's a reason, if I can identify a reason for the market to reverse in that area, that becomes I take a loss so I can take a win, and that's why I don't hold on to losses for very long, because they're preventing me from getting the winner. The loss is just a way of paying up for more information. Combining a lot of things all in one subject, but zippers are very, very important because it's where the market rests. That's why my trigger chart, I call this a trigger chart. My trigger chart is very short term and it shows these zippers very clearly.
Okay. Have you heard of, and what do you think about the SIP CTA fee increase controversy?
The what?
There's a CTA fee increase.
CTA as in commodity trading advisors?
Yes.
Like hedge funds?
Let me find a link real quick. Where did you
go? Who's increasing the fee? Is it the NFA or?
It looks like SEC.
Yeah, I don't. It's way out of my zone. It's not something I know anything about.
Okay.
I cannot address that.
All right, I'll leave it at that. Let's see. Where's the other question? Do you use a VWAP in your trading?
I don't use it to execute trades, but I do use it to gauge how the market is moving. If I'm long, let's say we move down and we push against support here and we start to move up, a VWAP and a mid are important areas for me to scale out to mitigate some of the risks. So I keep it on my charts. This is VWAP right here, this bright teal, I guess is what the color is. Terrible with color names, but this is the VWAP of the day session. And I do pay attention to when the market approaches it. I often find that when VWAP is on top of mid, on top of the point of control, it's a very good indication of balance. In fact, I have a study that uses those things to determine if a day is balanced or not. So you can see it's not very clear, but here yesterday, not today, you could see the point of control at 37.75. You could see VWAP ended up at 37.75, and the mid is at 37.50. This is a balanced market here. It's a way of identifying, kind of a technical way of identifying balance. When the market moves, when the market, the point of control and the mid move away from each other, and the VWAP move away from each other, it helps me identify markets that are out of balance. But other than that, I simply use it to exit trades because it tends to be a turbulent area. It tends to be an area that provides resistance initially or support initially when we approach, and it's an important gauge for trade desks around the world and institutions around the world, that and TWAP, for their performance. So if they're going to execute trades, they're likely to execute them at or before VWAP. So that's all I use it for, but I don't initiate trades based on VWAP at all.
Okay. And then I'll make this the last question. Do you think volume profile will ever become ineffective if too many people are using the tool?
So it is not a trading system. It is simply a way of displaying information. The key thing that volume profile shows you is a component that doesn't exist in candlesticks or point and figure or Renko or whatever. It is showing you how much participation there was at each price. So here's a volume histogram right here. This is just a volume bar. It's showing me that the first bar, traded whatever, 94,000 contracts. That's what it did. Okay, it's not showing me where in this entire bar's range, and that bar, the first bar of the day today, traded 3 points. It was a 3-point bar. It's not telling me where it traded in there. And so the volume profile is just giving you a gauge of what's happened inside of that candlesticks or bar or whatever you're using. And it's not a trading system. It's not a setup. It's nothing like that. It's just a tool. So the question is analogous with saying, do you think if enough people use candlesticks, they'll become extinct? It's just a candlestick. What you do with that volume is your edge. And to me, it's always going to be there because I always want to know where in the day. There are days where the market actually makes a higher high and higher low, but value makes a lower, the point of control and value makes a lower low and a lower high to the prior day. It is telling me that despite the fact that price has moved up and looks on a price action basis is trending up, value, or where the market found value to be, actually moved lower. So the next day, when I'm doing my high pose, that's going to weigh in pretty heavily. It's going to tell me the move up is likely to be fought. It's likely to not have anything backing it up. In fact, we got this on Monday. Even though Europe was closed, the move up on Monday was done on very thin volume. The point of control moved up to the top of the day, but the context is there wasn't much volume there. It put in a higher high, but the point of control really didn't move that much. And so the expectation was the next day we would move back to where the point of control was earlier, which was down here at in the 38 range. And that's where we ended up opening. We ended up opening just below 38 at 37 and trading around this high volume node. The next day, that's where we put the point of control for the day. So it's a really important part of a tool set. It's just amazing how many people will ignore the volume profile when actually it's giving you a way. It's like looking at the genetics, the DNA of something. You're looking inside of it as opposed to a doctor who's just taking blood pressure and blood sugar and heart rate and stuff like that and weight and height as metrics. Volume is giving you the blood analysis. It's giving you the DNA. It's giving you stuff that is much deeper. And so even if I use fibs or, Gartley or whatever you want to use, even if I use moving average, I would definitely put a volume profile up because you want to see where's the market agreeing on price. Because ultimately, if it involves price and if it involves people, it involves an auction. And the auction is all about how much traded where. The value of your Toyota is not determined by one person who bought that Toyota for $60,000 when it was a $24,000 car. The value of the Toyota is built on a lot of people buying it at $23,500 and $24,500, and the point of control is at $24,000 because that's the highest number of people who bought it there. So you buying it at $65,000 is way outside of value. It's an outlier. It doesn't really matter, and that's how price can be deceptive. You can get a price that's way out there, but it doesn't represent true value. True value is where the large number of people participated, and that's why I use it.
Okay. Well, that's the last question. As always, thank you for your time and excellent webinar and information you provide on a daily basis.
Absolutely. Thanks for having me on.
Absolutely. If your question was not answered during the webinar, you can contact FT71 via the website or email on the screen, or you can also go to the futures.io website and use the AMA thread and ask your question there.
It's actually, I would prefer that you use the AMA thread because your question is probably something somebody else also has, and so it creates an environment where there's a discussion and everybody can run through the thread and get the information they want, so that the next time we have an AMA, you already have a lot of the information that you would have asked for. So go there first if you have a question. It just creates a better way for everybody to benefit from the information exchange.
Absolutely. Thank you.
Very cool. Thanks for having me. Take care.